Good afternoon, everyone. Thank you for joining on this webinar on bonds. We're very happy to have you here. My name is Anand, and I'll be the host. With me is Avnish. He owns the product. He is the product owner for bonds. For the next couple of minutes, we'll cover the basics of bonds, types of bonds, and the risk rewards to it. So, without further ado, I request Avnish to start the presentation.
Hello everyone. This is Avnish. Uh, I'm handling the business side of all the bonds from sourcing to uh, operations and product side. So, hi guys. We'll be discussing the below topics that is shown on the screen. The first one we'll be starting with the basics of bond. What is a bond? What are the key terms to consider when investing in bond? And why should, as an investor, you should choose bonds as an asset class, um, and diversify your portfolio. What are the risks associated while investing in bonds? How can you do the investing in bonds with tap invest? What are the taxation in investing on bonds? What are the risk assessments and continuous monitoring that our partners, our vendors, NBFCs are doing? And yes, so let's start with basics of bonds. So I'll start with the definition. By definition, a bond is a loan instrument wherein an investor who is investing in bonds is basically lending a certain sum of amount to the borrower. Borrower might be a corporate entity, a private entity, might be a government, might be a public entity, PSU, you might say. So the mechanism that happens or works in the bond market is that there is an issuer. Issuer requires a certain sum of fund to deploy in his business. He doesn't want to liquidate through equity, so he can go to any certain merchant banker on an NBF or an NBFC, wherein the NBFC or the merchant banker usually subscribes the full quantum or generates a demand in the market so that the issue can be subscribed. As mentioned, the issuer can be a government entity, a public corporation, a private corporation. What is the purpose basically? So the purpose of the issuer is that he needs to raise large sum of money for variety of purpose, like he wants to acquire new plant, he wants to purchase any equipment, or he wants the fund to grow his business, or he wants to implement any scheme, whatever the purpose. It is generally inscribed in the term sheet, or what we usually say is information memorandum, IM. And whatever amount he is uh, asking from the investor, he pays a certain interest over it. So interest payment is usually as per the structure. So um, there are certain structures in the market wherein some issuer might choose to pay interest monthly or quarterly or semi-annually or on a annual basis, or he might choose that, he might say that I'll be paying interest along with the principal on the maturity date itself. So let's see an example. Say AB Limited. Say AB Limited raises money from multiple individuals or institutions and issues them a bond, which is then credited to the investor's demat account. In return, AB Limited will be paying a fixed periodic interest on the sums borrowed to the holder of the bonds. So, apart from the company's due diligence, there are certain terms that an investor needs to take care of while investing. So the terms are, the first one is coupon rate, the second one is yield, The third term is payment frequency. The fourth is maturity date, then security cover and all. So usually, whenever we interact with any investor, now they are if the investor is very new to the bonds market, they are usually confused by the coupon rate and yield. Usually, we see in the market that yield is usually higher and coupon rate is lower, just because they are able to invest at a discounted rate. So we'll be discussing what is a coupon rate. So whenever a bond is issued, there is always a face value attached to it. So face value defines how much unit will he will be accordingly investing in. Say if an investor needs to invest 10 lakh and the face value is 1000, then he'll be subscribing to 10 units of that particular bond. So the coupon rate is that is mentioned in the bond is will be paid according to the face value. Say the coupon rate is 12% and the issuer is deciding to pay on a monthly basis, then the investor will be receiving 1% of the face value. But if we come to the yield side of it now, the investor might not decide to invest at the face value. He might be able to procure the particular bond, or the bond might be trading in the market at a discounted rate, or at a premium rate. So whatever less he is paying now defines the yield. So yield is the interest rate, or generally we say it is an interpolated rate of return that an investor would earn if they held the NCD till maturity. The yield takes into account the coupon rate, maturity date, payment frequency, the current market price of the NCD. So, according to depending upon how much price the investor is willing to pay, or how much price the terms are negotiated now, we come up at a yield that he is generating over the particular bond. Payment frequency, as we already discussed, that it is inscribed in the term sheet. The terms or the intervals in which the issuer company will be paying the interest rate. It usually we usually see in the high yield segment that the interest is paid on a monthly basis, and um, there might be some instances where the interest is paid quarterly, or the issuer might be paying it yearly. Uh, yes. So apart from interest now, principal is also decided that the issuer wants to pay at maturity directly 100% of the quantum at maturity, or he might be paying principal amount as well in a staggered redemption way. The fourth term to consider is the maturity date. Obviously, whenever a investor is investing in bonds and paying the amount to the issuer, they decide upon a maturity date. At that date, the whole of the principal amount will be paid off, and the bond will be kind of redeemed. There is usually we see that there are a lot of senior secured and certain kinds of bonds available. So if there is a security given in the bond, the security will be over the assets of the company. Secured bonds are backed by a specific asset owned by the bond issuer. Asset is then taken charge over by the debenture trustee, who takes care of the uh, um, asset side. Asset is usually a recourse for the bond investor in the event of default by the bond issuer. So we are looking at a usual example of a particular bond, say XYZ Limited. The bond was issued on 1st of January 2020. The maturity date that was decided upon was on 31st December 21. The face value was decided at 1 lakh rupees. The issuer company, that is XYZ Limited, will be paying a coupon rate of 12%. Uh, the bond that is being issued is of senior ranking and is secured by a company's fixed assets as given here. The payment frequency, is quarterly. The interest is paid quarterly. The principal will be paid annually. Uh, Given the bond is for 2 years, so after 1 year, the principal will be half of the principal will be paid, and at maturity, the another half will be paid off. So if we calculate or pull the future values to the to 1 lakh rupees on 1st of January, na, we'll be getting at a will be the investor will be generating a yield of around 12.55%. This yield is usually stated in terms of IRR or XIRR, which means that your coupon that will be paid, coupon means the interest rate that is being paid quarterly, will be reinvested at a uh, yield rate, means IRR. So, by the perspective of the investor, uh, why should he choose bond over any other asset class? So, the first benefit by investing in bonds is the fixed and predictable investment. Um, suppose a investor needs to plan his future expenses, then he can choose a particular kind of bond that will be paying him at those intervals in which his liabilities or his expenses are already aligned. So in by the way of investing in bonds, investor actually knows at which date he will be receiving the future payouts. Unlike equity, wherein investor doesn't know how the markets will be performing, he might be in a loss at the time of liquidation. But in bonds, he can actually plan accordingly in which dates or in which time of the year he will be receiving the exact amounts. Usually, the bonds are structured in a way that they are safe. In bonds, there is always a lower risk of default compared to other types of instruments, such as stocks, which is because bonds are backed by the full faith and credit of the issuer. The total company's assets and liabilities are taken care of by during the process of issuance, and the proper safety measures are taken care of. A proper underwriting process is taken care of by the issuer and the merchant banker who issues the bond. Usually, in case of secured bonds, as we already discussed, that it is backed by assets which is then taken held as a charge by the debenture trustees, who acts in the behalf of the investors in case of adversities or in case the things go south. Uh, while investing in bonds, the investor is usually entitled to regular cash flows. So, if any investor is in the age of around 50 to 60 years now, he can align his investments in bonds so that he get regular interest payments, which will feel like ultimately a salary coming at the end of every month if he's investing in monthly interest coupon bonds. Um Another point is that it is held securely in demat. Bonds are not something that is on the paper. Rather than it is held in a demat account, which you can at any point of time track. And you hold the investor hold the right of the account, and he can always make a decision accordingly. Yes. So usually bonds are versatile and they have multiple features. So bond might be secured, might be unsecured, might be low yield, might be high yield. So an investor who is investing in a certain company might choose accordingly what kind of bond he wants to invest in. So if he is looking for a high yield, then he might go for unsecured bonds, or he might go for lower rated bonds. Accordingly, he can generate a higher yield on a particular issuer. Unlike equity, where you will be investing in the same price, you cannot have a versatile and multiple features attached to a particular issuer, which makes it flexible for the investor to able to find anything of their choice suitable for their diversification plan. Obviously, like any investments, there are certain risks associated. The first risk will be the default risk, which is a very unusual case, given that the proper underwriting is being taken care of, the due diligence is being taken care of by the investor. But there are certain scenarios when the company might stop paying you the interest amount along with the principal. If the company is not performing well, they doesn't have enough um, cash balance, or the company is shutting down. In that case, you might lose all your investments until and unless you will be constantly receiving the interest amounts. There are liquidity risks. Suppose if you the whenever an investor invests in bond, na, he locks his entire investment for a tenure. So if the investor requires that particular amount in between the tenure of the bond, he might be facing a liquidity risk wherein he will not be able to exactly sell his investment. He'll have to personally find a buyer, or might go to an OTC banker, wherein the banker will be arranging a transaction. Obviously, they will be taking a cut over it. There are price risk associated as well. The risk that the price risk means the risk that the value of the investment will go down if the interest rate rises. So for an investor, if he has decided that he'll be investing at in that particular bond at a particular yield, then there is no risk as such. But given that in the market he has already logged in at 10%, and other bonds in the market or the government is providing uh, certain kind of bonds at 12%. So if we see comparatively now, then his value of the bond is declining. So that's what we call a price risk. There are certain scenarios as well, like early redemption risk. An issuer might decide to early redeem the particular kind of bond, which is not usually the issuer is not feeling like he needs to repay, and he has certain cash balance he wants to repay. Then he can repay on a previous date, on early date. But however, this risk is mitigated by at the time of the structure of the bond, wherein certain clauses are inserted, where it is written that if you are early redeem, then you need to pay around 2% or 1% extra over the coupon that you are currently paying. So right now with tap, if you decide to invest in bonds, we are currently doing it offline, but we are working on the tech side of it as well. Hopefully we can see live flow, online bonds flow at our tap portal and our app in the coming next 10 to 15 days. Right now uh, we are doing it offline. The steps that are that you require to take into consideration while investing are, uh, first, you just need to inform your RM that you want a particular bond that we have listed. Then the communication might be on WhatsApp, or you just drop a mail to us, or you just need to click on the our NCD's deal page. Then after clicking on the NCD deal page, you will be provided with certain details of the particular NCD, along with the term sheet, cash flow, pricing, yield, and all. Then accordingly, you just need to confirm your investment amount on the date of transfer. The trade date is decided upon, uh, and it is well communicated in the mail. On the date of the trade, you just need to transfer the funds to receive the bonds in your demand on the same day. Now we'll be discussing on the taxation of bonds. So whatever interest, whatever coupon the investor is receiving is entitled to 10% TDS. The issuer company deducts a 10% TDS at the time of payment of the bond. say uh, say an investor is receiving around 1 rupee on a particular date by the issuer company, then he will be deducted at 10% TDS, and he will be receiving around zero point 0.9 rupees on that particular day. Uh, there are two components usually. The first one is interest component that you are receiving, and the second one is capital gains. So capital gain contains the difference between the price at which he has invested and the price of the redemption. Say an investor has invested at around 95 rupees, and the bond will be redeemed at 100 rupees, so he will be making a 5 rupee capital gain out of it at the time of maturity. So if he has invested in listed bonds and he has invested uh, in a bond which is maturing in say 11 months, which is below 12 months, then short term capital gain will be implied upon, and his respective slab rate will be applicable. And if he is investing in listed bonds which has a holding period of more than 12 months, then uh, there is no indexation benefit as well, but he will be taxed on a flat rate of 10%. But if he is investing in unlisted bonds, then below 36 month bond will be considered as a short term bonds, and the short term capital gains will be taxed at his respective slab rate. Uh, and if he is investing in unlisted bonds for more than 36 months, then whatever capital gain he will be generating will be taxed at 20% flat rate. So these are the risk assessments that usually our vendors, our merchant bankers from where we are sourcing the bonds, and the NBFC partners are doing. So usually they take the data, they collect the data from the issuer company, which includes their audited financials of the past 3 years, monthly MIS they ask, they take care of the fixed asset register, they have the bank account statements, uh, they project the current financials, and accordingly they decide upon key uh, this company is viable or not. Give me a second. So whatever data is being collected now, it gets transformed, which makes any sense. Then the company is given a scorecard with over 100 pointers. So there are certain points attached to every financial ratios or certain conditions that deemed suitable by the NBFC companies. They give points to particular companies, and if the issuer company crosses that point, that then they accordingly decide at what yield the issuance will be constructed. Obviously, a continuous monitoring happens from the merchant banker side, the NBFC side, wherein they check on a monthly basis that the company is performing well or not. Also, there is a debenture trustee appointed who takes care of the uh, assets that are being taken charge by the debenture trustee. If they also take care of the covenants that was signed in between the merchant banker and the issuer company. So if there are certain breach in covenants, then the debenture trustee comes into play, and they inform the investors accordingly that uh, there was a breach. They exactly state how much was the quantum of breach, and what all procedures an investor can proceed with. If the investors intimate that they want their investments back, then the venture trustee will be proceeding with the same. So coming up to the partner ecosystem, we have partnered with HDFC Bank, Yes Bank for our banking facilities. Uh, for taxation, we have Mr. Daga and company. Vijayawada Kavya and Sauji. We have partnered with trustee and escrow accounts for facilitation of the transactions. These are the list. Our sourcing partners are UB Financial, JM Financials, and recently we have also partnered with Oxizo. We have partnered with the Fixed Income Group, uh, SMC Global, and all. So that's all from my side. You can at any point of time contact me. Below is the given contact, wherein you can reach out to me if you have any questions, if you need the list of bonds that we are dealing with. So you can at any point of time comfortably reach out to me at WhatsApp or call, or you can drop me a mail, wherein I'll be available. So I'll be taking a few questions if you have any. You can also unmute yourself, or you can just type in the chat box. I'll be responding with the same. Hi, Venkatesh sir. If you have any questions, please let me know. Okay, then we'll be wrapping up the webinar. If you still have any questions and you could not ask, then you can drop me a mail or WhatsApp. I'll be more than happy to answer. Thank you. Thank you, everyone.
Thank you, Avnish. Thank you, Venkatesh, for joining. And I hope you have Avnish's number